So last year, this is kind of what the economic nexus by state chart looked like. Kind of ugly with all the different symbols, but the blue states had some sort of law regarding economic nexus. And some of those states actually were looking at it retroactively. We had mentioned Rhode Island initially. They had a law back in 2017 where they were one of the front runners. Alabama was the front runner, I believe. But Rhode Island was also one of the front runners to put these statutes in place, even though they knew they were unconstitutional. On this chart, I'm not sure why Rhode Island's not blue, but
too small to see anyway.
Maybe, yeah. This is what it looks like today. So pretty much everybody, and I'm going to talk about Kansas and Alaska, because those are exceptions to the rule, technically. Even with Kansas being blue, it's blue because the Department of Revenue put out guidance saying, hey, if you're selling into our state, then you have nexus with our state and should be collecting our tax. They didn't have a threshold. They just basically followed the South Dakota Wayfair decision with no thresholds at all. What was interesting is the state attorney general for Kansas came out and said, no, the Department of Revenue can't do that. What they've just done has no legal force and effect. So though Kansas, and that was their own attorney general that did that. So by doing what the Department of Revenue in Kansas did, they've basically squared off with their own attorney general. The reason they did that is they couldn't get the law passed. So there's been numerous bills in Kansas that have made it all the way to the governor's office, and she has vetoed each one of them. She has a good reason for vetoing each one of them. It has nothing to do with economic nexus. She's vetoing them because of all the additional pork and whatever you call it, pork barreling that the legislators do when they see a bill that is a slam dunk to pass. They'll throw all these tailors on that have nothing to do with the bill at all. They just throw them on there to try to get those passed, and they can be completely different than what the bill is originally for. So whenever that got to her office, she vetoed it every time. So they couldn't get it passed. She would say, she said, I don't like this, I don't like this, I don't like that. So I'm vetoing it. And then the Department of Revenue put in their, not really a rule, it's more of a guidance, and then they got their hands slapped by their own attorney general. So though Kansas is blue, it's technically unconstitutional, so they really don't have anything. Alaska is interesting. Alaska, most of us see Alaska as a state that has no sales tax, but they do. They have no state sales tax. The local jurisdictions in Alaska, a lot of them will have a sales tax. The reason you don't hear much about it is the two biggest jurisdictions in Alaska, Fairbanks and Anchorage, don't have a local sales tax. But all of these locations that you're probably never going to go to, you may never sell to, they'll have a tax rate, and it could be up to 9%. So Nome, the city of Nome, put an economic nexus ordinance through. So they're the only ones. So Alaska is technically gray here, but just know that the city of Nome recently passed their economic nexus rule. And Florida is the other one. Missouri, and Florida, and Kansas. The other gray states don't have a tax, a sales tax. Okay, just some things to point out on this chart. This is the state legislation for economic nexus. One thing to point out is look at Arizona. They have tiered their statute. So it's $200,000 threshold for this year. Next year it goes to $150,000, and the year after that $100,000. There is no transaction threshold, just a sale threshold. And you'll notice on the threshold criteria here, Most of them are gross, some of them are retail. The retail ones are more reasonable in my opinion. Those that are gross are somewhat unfair because you could technically, if you are a wholesaler and you are hitting the thresholds in all of your states, you technically have a filing responsibility, even though you have no tax liability.
That's your reseller filing, is that what you're talking about?
Like a wholesaler or a reseller, someone who's selling to
sell products to somebody else. They wouldn't collect retail sale because it's not a sale at retail by any state definition. But they're only looking at the gross sales to the state, not whether it's retail or not. Like DC is only on retail sales. So if you don't make retail sales to DC residents, you're fine.
Mm-hmm. So if you're always selling to resellers, then you could have a filing liability but no tax liability. Right. California, California, as we stated, increased theirs to 500,000 when it was 100,000, but it is sales of tangible personal property. My misspelling there. Connecticut is another one that reduced theirs. They went from 250,000 down to 100,000, but they left the and 200 transactions. So if you have $100,000 on 199 transactions, you technically don't have a filing responsibility yet. You have to hit both of them. The state of Kansas, we talked about. They're currently at any, which is, like we know, is unconstitutional, even under the South Dakota Wayfair case. Still unconstitutional. Massachusetts was 500,000 and 100 transactions, and they've reduced theirs to just $100,000 and took away the transactional portion of it. Missouri, as we stated, currently proposed. New York was another one that they had theirs at $300,000 and 100 transactions, and they've increased it to 500 because the 300 was just too burdensome for them. They weren't concerned about it. The taxpayers. It was too burdensome for them to process those returns. Because to be quite honest, the states don't want to process zero returns either because it's just a cost to them. But under some of these statutes, they have forced us to have to file a zero return because we're hitting the thresholds.
So, Robert, are you seeing anything on casual sales? You know, my example is sometimes you sell, I don't know, a piece of art, a very large jewelry transaction, but there's only one transaction, but it's over 100,000.
I think you have, if it's an occasional sale, if you don't typically sell art, then you're going to be protected under the occasional sale exemption in that state if they have one. You have to be careful in looking at those because sometimes they have an occasional sale exemption, but it's impossible to meet. California is a great example of that. Yes, they have an occasional sale exemption, but no one ever meets it. Missouri has an occasional sale exemption, but it doesn't apply to businesses technically. They put that statute in place for, like, if you're doing a yard sale. It's those kinds of transactions that can qualify. But once you get up a certain amount, I think it's $3,000, I want to say, in Missouri. Once you hit the $3,000, then you technically should be collecting the tax, unless you're doing a yard sale kind of.
So my favorite example is you have a person, in the old days, if you had a store that was in a single state and they shipped your product to another state, there was never sales tax. I mean, there was supposed to be use tax, but there was never sales tax on that. And it was very common. People would travel to a state and buy their major purchase and ship it home. Well, today, under these new rules, I think it's questionable as to whether you can really even do that. So, one shipment, if it's big enough, if it triggers, could cause a retailer to actually have been obligated to collect sales tax and register in the state into which it's shipping.
And I have a war story on that. This is going way back. This is before even Quill, I think, came into, maybe right after Quill in 1992. Shows you how far back I'm going. So this company made a one-time sale, one time, to the state of Ohio, and I guess Ohio had audited the buyer's return, whatever, and they were coming after the client for $1,000 in sales taxes. So we wrote it back in the old day, it was either the Bellis Hess case or the Quill, I forget which one was in effect then. And we said, well, you don't have any, because it's a one-time sale. It's all they did was one sale ever in the 50-year history of the company. Never sold anything to that state. They came back and wanted income tax returns in addition to the sales tax. So we ended up telling the client, if they reduce $1,000 to a judgment and they register it here in Missouri and write them a check, open up your checkbook, write them a check for $1,000. It wasn't worth arguing with them.
So with the states, like we said, there's only a few left. Notice that Washington, going to the next slide, Washington is $100,000 or $10,000 collector notice requirement. So if you're not hitting the $100,000, but you're at the above the $10,000, they still have a collector notice requirement in their state. That comes from the Direct Marketing Association case a few years ago in Colorado. Colorado was trying to get the states to force, or was really trying to get a case to go to the Supreme Court, which it did, but in that case, the Supreme Court ruled that since it was no tax, since they weren't requiring a tax, they're just requiring a notice, which is basically what I call the Tattletale Law. So if you're selling to customers in Colorado back then, then at the end of the year, you had to provide a report to the state of Colorado saying, these are all the people I sold to, if I sold above a certain amount to them. So these are all of my customers in Colorado. So that gave the state an opportunity to go after those customers because they technically owe the use tax, and they had no avenue of reaching that transaction. So they put that law into place to try to force the Supreme Court to force the sellers to start collecting tax everywhere. It didn't work because the court said this is not a good case to overrule Quill. But Justice Kennedy...
Yeah, I was going to say, Justice Kennedy filed a concurring opinion saying it's now time we revisit Quill.
Yeah, but this wasn't the case to do it.
Right.
And that kind of started that's when South Dakota Wayfair, that's when South Dakota, that's when Alabama, and they started putting statutes in place to try to get them to the Supreme Court, which eventually worked. But you'll notice that most states have gotten rid of their collector notice requirement because when that case went through, they started putting those laws into place because at least they'll know who's not paying the tax. Well, states have started to get rid of those. Washington, I think, is the last one to hold on to it.